PEB Capital. Build income. Protect wealth. Create legacy. The Cashflow portfolio. How to build monthly income from your assets. You could have $1 million net worth and still have a cash flow problem. Net worth tells you what you own. Cash flow determines how easily you can pay for your life. At some point, every serious wealth builder needs a plan for turning assets into reliable monthly income. For much of your working life, the mission is accumulation. You earn money, save a portion, and invest for long-term growth. But eventually the objective changes. Instead of constantly putting money into the portfolio, you may need your portfolio to start sending money back to you. That transition from accumulation to distribution requires a different mindset and a different system. A strong cash flow portfolio usually works best when every part of the portfolio has a defined job. Think in 4 buckets. Liquidity for expenses and emergencies. Income for recurring cash flow. Growth for protecting long-term purchasing power. And opportunity for capital you can deploy when volatility creates attractive prices. Liquidity covers near-term spending needs, emergencies, and short-term obligations. This bucket is not designed to maximize returns. Its job is to reduce stress and give the rest of your plan room to work. In difficult markets, liquidity often buys something priceless: time. The income bucket is built to generate recurring cash flow. Depending on your situation, that could include treasury securities, bonds, dividend-paying investments, real estate income, business distributions, and other dependable sources of income. The goal is not simply to chase the highest advertised yield. The goal is sustainable cash flow combined with intelligent risk management. Many investors become too conservative too early, but inflation never retires. A retirement portfolio may still need exposure to growth assets so purchasing power can keep pace over the years ahead. The right balance between growth and income helps support both current spending and future resilience. A portfolio can create value through several channels: interest, dividends, capital appreciation, and even planned asset sales. That is why total return matters. Instead of asking, "How big is my dividend?" ask a better question: is the portfolio sustainably supporting my overall financial plan? Imagine retiring and then experiencing a major market decline early in retirement while you are already taking withdrawals. That is sequence of returns risk. When withdrawals and volatility combine, damage can compound. A properly sized cash or short-term reserve can reduce pressure to sell long-term investments during a bad market. The cash flow portfolio works best when you create a simple distribution system. Income sources feed the portfolio. The portfolio replenishes a spending reserve, and a predetermined amount transfers into checking each month. Instead of spending randomly from multiple accounts, your portfolio begins operating more like a business with a planned paycheck. Never confuse a high yield with safe income. When an investment promises unusually high income, ask why. Could the dividend be cut? Could the principal fall sharply? Could liquidity disappear? Income matters, but preservation matters too. The goal is not simply to accumulate the largest account possible. The goal is to build assets capable of supporting the life you want. Growth builds future purchasing power. Income supports today's lifestyle. Liquidity creates flexibility. And disciplined risk management helps protect the entire system. That is the cash flow portfolio. If this video helped you think more strategically about income and wealth, subscribe to PEB Capital. In the next episode, we answer a practical question every investor asks: how much cash should you actually keep? Build income. Protect wealth. Create legacy.